I have lived long enough to see the same mistake wear many different suits. Sometimes it shows up in a banker's office with a polished forecast and a stack of charts. Sometimes it shows up in Washington wrapped in patriotic language. Sometimes it shows up in a family living room as quiet confidence that a savings account, a pension statement, and a few government bonds are a permanent form of safety. The costume changes. The mistake does not. The mistake is believing that wealth is whatever the statement says it is. The mistake is believing that the measuring stick is stable because the people who print it are powerful. The mistake is believing that a system that has worked for a long time has earned the right to work forever. I have spent my life thinking about capital, and the more years I put behind me, the less I confuse money with wealth. Money is a claim. Wealth is command over real things. Wealth is food, energy, productive land, durable businesses, useful infrastructure, trusted brands, pricing power, and ownership in systems that keep producing regardless of who is giving speeches in the Capitol. That distinction matters most at moments like this. Most people think wealth shifts happen like a Hollywood movie. They imagine one ugly morning, one market panic, one headline so loud that nobody can miss it. They imagine a crash with sirens. They imagine a single day when the old order dies and the new one is born before dinner. History is rarely that theatrical. The largest transfers of wealth usually happen while people are still going to work, still paying bills, still arguing over politics, still watching stock prices in nominal terms, and still telling themselves that things feel basically normal. The transfer is not hidden because the facts are unavailable. It is hidden because people measure the wrong thing. They count dollars and fail to count what those dollars can still buy. They count portfolio values and fail to notice that the currency doing the counting is slowly losing credibility. That is why moments like this are so dangerous for ordinary savers and so profitable for disciplined owners. When I look at the world right now, I do not begin with drama. I begin with pattern. The source you gave me keeps coming back to the same valuable insight. Every durable monetary order begins with discipline, grows into confidence, drifts into overreach, and eventually loses control, not in one theatrical instant, but in a long process of weakening trust and shifting purchasing power. That is the line in the source text that matters most. And it is the line worth keeping. Fay file site, Fay turn 25, file 0 Fay. A great power establishes the rules. People accept those rules because the system works. Trade expands, credit expands, living standards rise, the leading currency becomes not merely useful but default. Then success breeds a very specific kind of carelessness. Debt becomes easier to justify, monetary discipline becomes easier to relax. Political promises multiply faster than productive capacity. The privileged country discovers that because the world needs its currency, it can borrow more, spend more, and postpone harder decisions longer than anyone else. That privilege always feels like genius while it lasts. Then comes the subtle turn. The country that writes the rules begins to rely on its position instead of renewing the foundations that gave it that position. It leans on finance harder than production. It leans on borrowing harder than saving. It leans on narratives harder than arithmetic. Outsiders watch, rivals adjust. Creditors become more careful. Central banks start preparing for contingencies they would once have dismissed as unthinkable. What began as confidence hardens into complacency. And complacency slowly invites challenge. If you understand that much, the rest of the cycle becomes easier to see. Rome did not lose its standing the day the denarius became visibly weaker. The damage started when the rulers of the day chose convenience over discipline and learned that debasement solved immediate political problems while quietly creating much larger social ones. The Dutch did not wake up one morning and find out the world had moved on in a single afternoon. They discovered over time that financial brilliance cannot rescue an overextended order forever. Britain did not stop mattering because somebody held a ceremony announcing the end of sterling supremacy. Long before the formal handoff, the structure was already weakening beneath the surface. In each case, the people who suffered most were the ones who mistook the continuity of routine for the permanence of value. That is the part many people miss. An empire can remain administratively alive after its financial advantage has already begun to decay. A reserve currency can remain dominant long after the first cracks in trust appear. The public can continue using the same notes, the same banks, the same familiar phrases while the underlying bargain is already changing. If you only watch for collapse, you will miss the transfer. That is why I do not think the central question is whether the United States wakes up tomorrow and finds the dollar worthless. That is a childish way to frame an adult problem. The serious question is whether the dollar can continue to do for America what it has done for decades: absorb excess issuance, finance expanding deficits, support a debt burden that grows faster than honest tax revenue, and let the nation export part of its adjustment cost to the rest of the world. If that privilege weakens, even gradually, the consequences are enormous. The United States built an extraordinary system after the Second World War. That is not propaganda, it is fact. American productive power, military reach, financial architecture, and institutional credibility created a monetary order that few countries in history have ever matched. The dollar became the world's default reserve, not because people were forced to admire it, but because for a long time it sat at the center of the most trusted and most productive system on earth. That was the foundation. What concerns me now is not the foundation, it is the long distance we have traveled since discipline actually sat underneath it. Once convertibility ended, once deficits became routine rather than exceptional, once debt expansion stopped being a tool of emergency and became a permanent feature of ordinary governance, the nature of the system changed. The arithmetic stopped asking whether new promises could be paid for by future productivity and started assuming that scale, prestige, and monetary flexibility would always cover the gap. That assumption is where great systems grow careless. People tell themselves that a country issuing the world's reserve currency plays by different rules, in one narrow sense. That is true. Reserve currency status buys time. It lowers immediate pain. It increases tolerance for imbalance. It turns what would be a crisis in another country into a manageable headline in your own. But buying time is not the same thing as canceling consequences. It simply spreads them out, disguises them, and makes them politically easier to ignore. I have never seen a debt problem solved by pretending that duration is a cure. The source text uses a powerful point that should not be thrown away. The process becomes urgent when other countries begin preparing for life with less dollar dependence, not because they have already built a perfect alternative, but because trust in the incumbent no longer feels unconditional. That is a far more important idea than the usual television debate over whether one rival nation or another is ready to replace the United States tomorrow. Great transitions do not require a flawless successor. They only require a gradual reduction in the monopoly of confidence. Fay file a site, Fay turn 25 file 0 Fay. That is exactly why central bank behavior matters so much. When official institutions that normally move slowly and talk cautiously start accumulating physical gold aggressively. I pay attention, not because gold has suddenly become magical. Gold is not magic. Gold is simply money without a politician attached to it. It does not promise growth. It does not mail you coupons. It does not impress people at cocktail parties. What it does offer is independence from somebody else's printing press, somebody else's fiscal appetite, and somebody else's election cycle. There are times when that kind of independence is worth more than elegance. I do not advocate worshiping gold. I have always preferred productive assets that compound. A good business is a marvelous thing. Productive land is a marvelous thing. Energy assets that throw off useful output are marvelous things. But when central banks that understand monetary history better than the public begins moving toward hard reserves, I do not dismiss it as superstition. I read it as a signal. It tells me that people with long memories and large responsibilities are less interested in promises and more interested in collateral that cannot be diluted by decree. That should make every ordinary saver stop and think. The public conversation is still strangely relaxed. People debate whether inflation is 1 point higher or lower than expected. They debate whether rates will be cut this quarter or next quarter. They debate whether the next productivity wave will solve everything. These are not useless questions, but they are often asked at the wrong altitude. If the deeper issue is long-cycle monetary credibility, then arguing only about the next policy meeting is like arguing over a restaurant bill while the foundation of the house is settling under your feet. The more useful question is this: what kinds of assets preserve command over real life when the measuring stick itself is losing quality? That question makes people uncomfortable because the answer is rarely convenient. Cash feels safe because the number does not move around. But a stable number attached to a shrinking claim is not safety. It is anesthesia. Long-duration bonds feel respectable because they come wrapped in official language and mathematical neatness. But lending for decades at yields that can be overtaken by monetary erosion is not prudence. It is slow surrender dressed up as discipline. Large savings balances in a single debasing currency can feel wise right until the owner realizes that nothing dramatic happened except a long series of small thefts. That is how ordinary people get poorer without ever feeling the moment of loss. They do not lose their wealth in one violent event. They lose it through a decade of groceries, insurance, taxes, healthcare, housing, and energy moving one direction while their supposedly safe claims move another. They lose it through nominal illusion. They lose it through an attachment to statements rather than purchasing power. They lose it through a lifetime habit of calling any non-volatile line item safe, even when that line item is denominated in a unit being stretched every year. This is why I keep returning to productive reality. A farm does not care what slogan won the last election. An oil field does not ask a central banker for permission to exist. A railway does not become fictional because a minister announces a new framework. A good business with pricing power, low capital intensity relative to earnings, and products people need can adjust, pass through costs, and continue compounding. The owner of such assets may suffer volatility, but volatility and impairment are not the same thing. One shakes your emotions. The other changes your destiny. Most people confuse the two. They are calm while a cash balance is being eroded. They panic while a superior business is temporarily marked down. They feel comfort when they are being diluted and fear when they are being offered ownership at a better price. In a transfer period, that inversion becomes fatal. The people who emerge with their wealth intact are usually the ones who can tell the difference between a noisy quote and a weakening claim. The source document is also right to reject the easy slogan that technology alone can save an overextended financial order. This is another place where the public loves a beautiful story more than hard arithmetic. Productivity matters, innovation matters. Artificial intelligence may be transformative in many fields, but no technology wave automatically rescues a fiscal structure that keeps producing obligations faster than it produces the honest surplus needed to cover them. A stronger engine does not solve a leaking tank if the driver refuses to repair the leak. Faithfully cite Fayturn 25 File 0 Fay. I have seen many people fall in love with the wrong level of analysis. They see a marvelous new tool and assume it will fix every unrelated weakness in the surrounding system. Sometimes it helps, sometimes it enriches certain owners magnificently, but a debt structure, a spending culture, and a currency regime have their own logic. They are not automatically redeemed because a new industry arrives with impressive growth rates. Japan gave the modern world a good lesson on this. Sophisticated technology can coexist with decades of debt burden and slow grind. Cleverness and balance sheet repair are not interchangeable. That is why a mature investor must hold two ideas at once. You can believe in innovation and still distrust monetary excess. You can admire technology and still diversify away from a single measuring stick. You can own excellent businesses tied to long-term productivity while also recognizing that claims fixed in nominal terms are vulnerable when the unit itself is weakening. Serious capital allocation lives in that kind of nuance. It refuses all or nothing slogans. Another mistake people make is waiting for a perfect replacement to appear before they take the weakening of the current order. Seriously, History does not work that way. Trust does not disappear all at once and reappear instantly elsewhere. It leaks, it fragments, it reallocates. Trade settlements shift at the margin. Reserve preferences shift at the margin. Bilateral arrangements multiply. Gold flows quietly. Commodity producers begin accepting more than one avenue of payment. The incumbent still dominates, but it no longer dominates with the same aura of permanence. The first loss is not market share. It is unquestioned confidence. Once that slips, the future path becomes much narrower. Now, I am not interested in frightening people for sport. Fear is a poor investment strategy. Panic is even worse. The right response to a long wealth transfer is not theatrical collapse thinking. It is calm repositioning. It is refusing to be overconcentrated in the exact forms most exposed to gradual debasement. It is refusing to measure your entire future in the liabilities of a system that is stretching itself. It is moving away from passive assumptions and toward intentional ownership. That kind of preparation feels boring right up until it becomes priceless. When I think about what ordinary families should internalize during a period like this, I come back to something very simple. Your life is not financed by headlines, it is financed by purchasing power. Can you still acquire necessities, opportunities, and time? Can your savings still buy future freedom? Can your investments adjust with the world? Or are they frozen in nominal assumptions built for a different era? Are you an owner of assets with real output? Or a holder of promises whose value depends on political restraint that no longer exists in the same form? Those are the questions that matter. A lot of people discover too late that what they called diversification was simply a collection of claims all linked to the same monetary foundation. They owned cash, bonds, domestic index funds, heavy with rate-sensitive valuations, and retirement promises, all ultimately resting on the same broad assumption that the measuring unit would remain trustworthy enough to preserve long-term purchasing power. That is not always diversification. Sometimes it is concentration wearing a tuxedo. Real diversification is messier than that. It means some exposure to productive enterprises. It means some exposure to assets tied to energy, materials, transport, food, or land. It may mean some exposure to gold, not as a religion, but as monetary insurance. It means understanding geography. It means thinking about what parts of your life and balance sheet would still hold their usefulness if the next 20 years produce more inflation, more financial repression, and more quiet erosion than the last generation became accustomed to. It also means keeping your mind clear about timing. One of the cruelties of long cycle transitions is that they can make prudent people feel foolish before they make them look wise. Hard assets can underperform for stretches. Gold can seem dead money until suddenly it is not. Energy can be hated until scarcity matters again. International diversification can look unnecessary until domestic concentration becomes the obvious mistake. The crowd will mock the insurance policy until the fire reaches the neighborhood. That is normal. The crowd always does its best thinking after the evidence is overwhelming. I would rather think before it is comfortable. The source document also uses a phrase I find useful in spirit, even if I would word it more conservatively. The wealth shift has already started. I agree with the underlying point. You do not need a formal ceremony to know that a transfer is underway. If global debt keeps climbing, if deficits become structural, if interest expense swallows more fiscal space, if reserve managers keep buying hard collateral, if the world experiments with more non-dollar settlement, and if the public keeps mistaking nominal portfolio levels for real protection, then the transfer is already in progress. It may be gradual, it may be uneven, it may even pause at times, but it is real. Fay file a site, Fay turn 25 file 0 Fay. You can see it in everyday life. You can see it when families earning what once looked like fine incomes discover that their margin of safety has thinned beyond recognition. You can see it when home insurance, health care, taxes, and food quietly absorb raises that exist only on paper. You can see it when older savers who did what they were told, worked hard, held conventional fixed income, and avoided speculation realize that caution alone did not protect them from a changing currency regime. You can see it when the people best positioned are not necessarily the ones with the highest salaries, but the ones who own scarce, useful things. Ownership becomes more important as trust in paper claims weakens. That has always been true, and I doubt this century will repeal it. I also do not believe every hard asset is automatically good or every soft asset automatically bad. That kind of lazy sorting causes as much trouble as blind faith in the old order. A terrible business attached to a fashionable real asset theme can destroy capital just as efficiently as a weak bond portfolio. Quality still matters, price still matters, management still matters. The world does not become simple because the cycle is visible. If anything, discipline matters more. You want businesses that can raise prices without losing their customers. You want balance sheets that do not depend on easy refinancing forever. You want assets connected to essential demand, not just speculative enthusiasm. You want an owner-S mentality, not a renter-S mentality. You want claims on production, distribution, logistics, energy, food, data infrastructure that people actually use, and brands that sit in the mind of the customer. As default choices, you want resilience, not just excitement. That is not sensational advice. It is the kind that survives. The public always wants a secret shortcut at moments like this. Which one asset will save me? Which single trade captures the whole transition? Which prediction produces instant certainty? I have never built my life around that style of thinking. The real answer is more mature and less glamorous. You prepare by refusing fragility. You prepare by owning reality. You prepare by giving yourself multiple ways to survive monetary erosion and only limited ways to be ruined by it. That is how serious people handle long uncertainty. There is another reason I find this topic so important. Most wealth losses in debasement periods are not suffered by speculators chasing thrills. They are suffered by decent, hard-working, rule-following people who trust the conventional definition of prudence. They save in the official instruments. They believe the central promise. They assume that because nothing illegal or reckless is happening in their own behavior, the system will reciprocate with fairness. Then they discover that prudence inside a changing monetary regime requires more than obedience. It requires adaptation. That lesson is painful, but it is liberating once accepted. Once you stop asking whether the old measuring stick deserves eternal loyalty, you begin asking better questions. What is truly scarce? What is truly useful? What can raise prices when currency weakens? What assets are someone else's liability, and what assets simply exist? What is dependent on policy kindness, and what can stand on its own legs? Where am I mistaking familiarity for safety? Where am I allowing stability of quotation to distract me from instability of value? Those questions sharpen judgment. They also expose comfort-seeking behavior that people call investing. I would add one more thought that matters to me personally. The purpose of protecting wealth is not to worship wealth. It is to preserve freedom. When monetary systems weaken, freedom becomes more expensive. The ability to wait, to choose, to reject bad opportunities, to help your family, to withstand mistakes, and to think clearly all depend on retaining purchasing power. That is why this subject is not abstract. A long erosion in the measuring unit is not just a technical finance story. It is a story about how much life choice remains in the hands of ordinary people. When the measuring stick shrinks, dependency grows. I have no interest in dependency. So if you ask me what side of this transfer I want to be on, the answer is obvious. I want to be on the side of ownership over promises, production over rhetoric, useful assets over soft assumptions, and measured preparation over denial. I want my capital tied, as much as practical, to the world people must continue living in, rather than to the stories politicians must continue telling. I want to own things that remain necessary after the next press conference is forgotten. That is not cynicism. It is stewardship. History rewards people who can separate the page from the substance. The page says your account balance is higher. The substance asks what that balance buys. The page says the bond is safe because the coupon arrives. The substance asks what those coupons will command 10 years from now. The page says the reserve currency is still dominant. The substance asks how much of that dominance is habit, how much is necessity, and how much is now being quietly rerouted in vaults, contracts, and balance sheets far from the television studio. The page is where comfort lives. The substance is where wealth lives. I do not know the exact date of any turning point, and anyone who pretends to know it precisely is selling performance. But I do know how to recognize a process. I know how to see what matters when institutions with long memories start reaching for hard collateral. I know how to see what matters when debt grows faster than honest capacity. I know how to see what matters when official confidence remains loud while reserve behavior becomes more cautious. I know how to see what matters when families feel poorer in practice, while statements insist they are doing fine. That combination is not random. It is diagnostic. The great wealth shifts of history did not announce themselves kindly. They gave signals, they offered clues, they rewarded observers willing to endure ridicule before applause. They punished those who demanded certainty before acting, and in the end they transferred purchasing power away from passive holders of weakening claims and toward owners of durable reality. I see no reason to assume our age has been excused from that old logic. What we are living through now may not end with one empire collapsing in the style of ancient textbooks. It may look more bureaucratic than that, more financial than military, more gradual than cinematic. But a transfer does not need flaming ruins to be real. It only needs a measuring stick that keeps shrinking, a leadership class that prefers expedience to repair, and a world that slowly decides it would like more optionality than the old arrangement offers. Look around and tell me that is not already happening, so I come back to where I began. Wealth is not the number printed on the statement. Wealth is command over real life. The people who grasp that early are rarely the loudest people in the room. They are usually the calmest. They do not need to predict every quarter. They do not need to win every debate. They simply refuse to stand still while the ground under the measuring unit is moving. That is the temperament I trust. If you hold large piles of what can be diluted, if you depend entirely on promises fixed in nominal terms, if you are counting on policy brilliance to outrun arithmetic forever, then you are making a bet whether you realize it or not. You are betting that this time a dominant system can overextend without paying the historical price. You are betting that exceptional language will achieve what no previous great power achieved. You are betting that trust can be spent without limit. I would not make that bet. I would rather own pieces of the world that still matter when the slogans fade. I would rather hold some form of monetary insurance that does not require the restraint of a legislature. I would rather own productive businesses, useful assets, and claims on essential output. I would rather think in purchasing power, not in patriotic sentiment. I would rather prepare while preparation is still possible at tolerable prices than scramble after the crowd once the visible phase arrives. In my experience, the best time to respect a long cycle is before it becomes obvious to people who never study cycles. That is where I believe we are now. Not at the end of the world, not at the beginning of an overnight collapse, not at a moment when panic is appropriate. We are at something more demanding than that. We are at a moment when seriousness is appropriate. We are at a moment when the old order still functions well enough to lull the majority, but poorly enough underneath to reward those who stop confusing money with wealth. And when history offers me that distinction, I do not ignore it. I follow it